My name is Olivier Desbarres. I'm a London-based independent macro and currency strategist. The emerging market carry trade has done reasonably well, but perhaps not as well as one would expect, given the carry and rising global growth in trade. If developed central banks get their timing and communications wrong and end up hiking in unison, the carry trade may wobble for three reasons. Firstly, higher relative US/developed rates would erode the relative appeal of EM high yielders. Secondly, higher developed rates would increase financing costs for emerging market economies and corporates. Thirdly and finally, a stronger dollar or stronger funding currencies would increase the debt repayments in local currency terms. Many emerging market central banks, including in Latin America and Indonesia, still have only modest FX reserves, so there isn't much scope for them to defend their currencies if under significant pressure. How much scope is there, if any, for reflation in the event of a major equity sell-off and/or a slump in global growth? I would argue that in the event of a global market correction and slowdown in economic growth, there is limited scope for reflation. Policy rates are still near or at record lows in most developed economies, and central banks seem reluctant to expand or reignite their QE programs. Household saving rates are already very low in most developed economies. Thirdly, there are signs that commercial banks are already tightening lending standards and curbing loans. The UK is a point in hand. Finally, the scope and appetite for fiscal stimulus is modest, at least in Europe, given the self-imposed 3% of GDP ceiling. Ascertaining whether equities are overvalued is a notoriously tricky proposition, and different answers can be fashioned by the way equity valuations are measured. PE ratios are a good starting point, and clearly higher corporate earnings have helped drive share prices higher, including in the US. By some estimates, PE ratios in the US are only slightly higher than the long-term historical average. Others, which strip out 2009, a period of very low earnings, and certain sectors, such as tech, show that US equities are overvalued. But there does not appear to be a strong, overwhelming consensus that stocks are significantly overvalued. Earnings season, which has kicked off in the US, will clearly give us a better sense of whether this optimism is justified. In the past 2 decades, it's worth noting that the S&P 500 has on average rallied over 2% in the month after the start of Q3 earnings season, and rallied in 4 out of every 5 years. Moreover, earnings per share forecasts appear conservative, even if we take into account the likely hit to insurance companies' profitability following Hurricanes Irma and Harvey in the US. Slightly better than expected earnings could provide a floor under equities and mitigate or delay the risk of a bigger correction to early 2018 when Q4 earnings will be released. After such a strong bull run, a 5 or 10% correction in equities is certainly not unfeasible. Something as benign as reports of a few large sovereign wealth funds or hedge funds taking off some risk or taking profit into the end year could be the catalysts.